As we had anticipated, CY24 was the year of all-rounders, with strong performance across all asset classes. US economy has demonstrated robust growth largely due to strong retail sales and a resilient labor market. Despite a total of 100 basis points in rate cuts since September 2024, the US 10-year yield has actually risen by approximately 100 basis points. The latest dot plot now suggests only 2 more rate cuts, instead of the 4 previously anticipated. This implies a higher for longer interest rate environment. China's sluggish growth and falling inflation are fueling recessionary fears, with bond yields at multi-year lows. GDP growth, while stabilizing, remains weak. India's macros have moved from being strong to stable due to slower GDP growth, sticky inflation, and rising trade deficit. The first half of 2025 is uncertain, with a series of key events set to unfold. However, we anticipate greater clarity emerging in the latter half of the year, and the outlook appears to be leaning towards the positive side. The proposed policy implementations by President Trump are a key concern. Expectations of these measures have already led to a strengthening of the dollar index and a rise in the US 10-year bond yield. Any sharp moves in these metrics are likely to impact emerging markets. Proposed tariff measures, if implemented, will have severe impact on the global trade as well as economies. China's reaction to support its economy, especially yuan depreciation, could also impact Indian rupee against the US dollar. GDP witnessed faster recovery when slowdown was caused by global events. However, the slowdown of 2012-13, which resulted mainly due to domestic concerns, saw gradual recovery. This time also, although signs of uptick are emerging, we expect the recovery to be gradual. Nifty 50 gained for the 9th consecutive years, the longest streak in the history. However, total returns are the lowest in this streak. FII outflows have been offset by inflows from DIIs and retail investors. Meanwhile, mutual funds continue to experience net inflows, with SIP contributions now surpassing 25,000 crores. The temperature gauge index remains in the fair value zone. Equity markets consolidation phase is likely to be continued during first half of the year. Key events like actions by Trump on both trade and fiscal front, China's measures to revive the economy and union budget of India may keep the volatility on the higher side. Other important monitorable events will be corporate earnings and pickup of economic activity in India. We believe clarity on all these front to emerge gradually, and markets will likely factor all this during first half of the year. It is advisable to tread with caution by adopting a strategy which is balanced and resilient. From longer-term perspective, India continues to remain stable and growing economy. Earning growth is likely to be robust for next 2 years. Based on their risk profile, investors having the appropriate level of equity allocation can continue to remain invested. Considering the recent corrections, if equity allocation is lower than desired levels, investors can increase allocation by implementing a lump sum investment strategy for hybrid equity-oriented fund and staggered approach over the next 6 months for pure equity-oriented strategies with accelerated deployment in the event of a meaningful correction. With the evolving interest rate scenario, the fixed income portfolio should be overweight on accrual strategies and neutral on duration strategies. With regards to duration, since majority of easing of the yields in 10-year GSEC has played out from 7.35% in October 2023 to 6.75% in December 2024, we believe only the last leg is left in terms of easing of yields, which can be played through longer maturity GSEC bonds or funds, albeit interim volatility. 15% to 20% of the portfolio may be invested in actively managed duration funds or long-term, 15 to 30 years average maturity, GSEC papers or funds. Accrual can be played across the credit spectrum by allocating 40% to 50% of the portfolio to performing credit and private credit strategies. In VEETs and select NCDs, 25% to 35% may be invested in performing credit strategies, NCDs, and in VEETs. 15% to 20% may be invested in private credit including real estate and infrastructure strategies, and select NCDs. 15% to 20% of the portfolio may be invested in arbitrage funds, minimum 3 months holding period, floating rate funds, 9 to 12 months holding period, absolute return long or short strategies, minimum 12 to 15 months holding period. For tax-efficient fixed-income alternative solutions, 20% to 25% of the portfolio may be allocated in conservative equity savings funds, minimum 3 years holding period. USD share of global reserve currencies continue to decline over last 10 years as central banks pile up on gold and alternates. This trend may continue amid geopolitical tensions and trade war concerns. Gold is likely to benefit from these along with INR depreciation.